All right, good morning, everybody, and happy Monday. We're finally here, the absolute final stretch of 2025. I hope you had a good weekend. I know the next couple of weeks are going to be a little bit different, right, in the sense that we are certainly winding down. I want to talk a little bit about the time of year here today and tomorrow, and we'll probably talk about that a lot as we start back in January. With a word of caution, because I actually think we're entering a couple of typically January through March tend to be quite difficult months for the market. Not that they're down necessarily, but they can be very choppy. Can be, don't have to be, but they can be. So if I were to say sort of what's the most difficult period of the year for markets, and of course, markets is a very loose term here. Markets are wide spanning. I think for the most part, people tend to think markets mean stocks, but believe it or not, stocks are heavily influenced by all the other markets, right? So maybe keep that in mind as well. Thanks for being here. Much appreciated for our second to last session of Set the Market for 2025. If you're here for the first time, we appreciate you being here. So thank you all. It's been a great honor to be able to go through the markets together once again this year. And I think we're getting better and better at this show. We have a lot of plans for the new year, how to make this a lot more interactive. We've been trying to get guests, or we've entertained the idea of getting guests, but we actually think it actually kind of waters down the experience. I think a lot of people appreciate the morning call because it's really to the point, 10, 15 minutes, getting right to it. We have a lot of other avenues on our YouTube channels and podcasts where we have guests, of course. I feel best that this morning call, and that's, again, I think that's where the feedback has been as well, is most beneficial. So I would say let's get started. Again, if you are new here, welcome. Just give me 1 second. Okay. If you're new here, thank you. Please make sure you subscribe to the channel. Please make sure that you give us a thumbs up like on all the videos that you watch here. That really helps us to be able to continue to do the show. We were actually going to stop this show for really maybe forever once at the end of the year. But we had so many people tell us that they really love it. So we said, you know what, let's give it another quarter. Depending on how the interaction goes, we will then continue it. If not enough interaction, then we will, of course, shut it down. But we do have a lot of plans. I think we can implement here. And again, the people love the content, so we will continue doing it for now, at least for another quarter, and then we'll see where we go. So let's get started. So thank you all for being here. We are at a point in the year, or in sort of the seasonal calendar, if you will, where things are slowing down. They've been slowing down for a couple of weeks now, I think. And what we are noticing is that there's a lot of people out there with not that much experience in the markets that tend to get active in the markets just as things slow down. And, this is a difficult one sometimes for people to hear. I understand why they're doing it. A lot of people, have less to do because life slows down during the holidays. And so they think that it's a great time to trade. Empirically, it's one of the worst times to trade and do a whole lot. Obviously, there are differing opinions on that as well, so I do not want to impose that view on too many people, but certainly that's in the professional circuits how it's looked at. I can tell you, if I walk around town here, it is empty streets for the most part, and professionals are not really doing much of anything. In fact, they're not doing a thing. Right now, the books have been closed for the most part. It's a retail and a machine-driven game right now for the next few weeks. So a lot of people think, okay, great. So then when we come back in the new year, and I'm looking at the calendar right now, the first trading day of the year is either the 2nd of January, which is a Friday, or the 5th of January. I'm going to tell you right now that I would be hard-pressed to do much of anything in any meaningful fashion, probably for the first couple of weeks of the year. There's always something to do, but the tricky part about the new year as we start going into it is to me, in my experience in the past 26 years, it's a total coin flip. Now, this is from a trading perspective, right? From an investment perspective, there's a lot of stuff to do. I'm hoping that everyone's reshuffling their portfolios. If you haven't had a portfolio scan with us yet, we're happy to do that for you. We have a piece of software. We can look at your portfolio and scan it. It's not advice. It's just a scan. If you have a portfolio, you have to have a portfolio, not just a trading account, of course, for that to make sense. So you can reach out to our team if you want to do that. But that's the investment aspect of it, right? That's typically what tends to be the majority of people's money, where there are changes to be made. From a trading perspective, the beginning of the year is really, really difficult. In fact, I always tell most of all of our clients actually, that the first quarter of the year, as I mentioned before, as much as it doesn't have to be a down quarter, it tends to be really choppy. And that means you can have really big rallies. It means you can have crappy sell-offs and anything in between. So I don't really see an edge, to be honest with you, in the first quarter of the year. From a trading perspective, I tend to think that positions should be carried for a shorter period of time. There's so many Januaries where I've gotten chopped up, but I've learned that over the years. It takes a toll on you after a while, and you put in a lot. There's the risk of putting in a lot of effort in the month of January and February, and doing a lot of little trades and getting cut up into pieces and then having lost all the confidence for the year. What I think January is better for is to take a step back, make a plan, prepare, observe, do some trades, right? It's actually a really important time of year to start monitoring the markets and making changes in portfolios. But I don't think it's a frantic trading environment, January, February. It tends to be choppy. Again, there tend to be good rallies and pretty good sell-offs, and anything in between. So it's not like there's nothing to do, but the worst thing we can do as traders and investors is to lose all of our confidence right out of the gate in January. And believe it or not, there's going to be a lot of people, and they do it every year, that have their New Year resolutions, right? And they're going to come back in the first trading day of the year, which is either the 2nd or the 5th of January this year, and they're going to be gangbusters punching out trades, and they're going to get absolutely punched in the teeth like this dude the other day in the fight on Netflix, and they'll either be done forever for the year, for the quarter, or not, depending on how much money they put after it. So that's just a little bit of sort of, I guess, words of wisdom, or just in my experience over the past 26 years or so, which gets me to where we are right now. So let me take a quick step back, and then we're going to look at 2-year yields. We're going to look at NVIDIA, and I want to talk a little bit about reflecting on the year as well. And then we will, just in case you're joining right now for the first time, we are going to be doing obviously we're doing Set the Market today. We're going to do it one more time tomorrow. Tomorrow is the 23rd of December, and then we're done for the year. I need to recharge my batteries. I'm sure you guys do too. So that's the plan here for Set the Market for the rest of 2025, for the few days that are left from a market's perspective. So let's have a quick look at where we are in terms of performance year-to-date. I think this is important. So from a year-to-date perspective, you can see the technology stocks are once again the best performing sector of the S&P 500. However, it kind of masks the real performance, which we've been talking about here now for quarters and quarters and quarters. Actually, well, not more than 4 quarters, because the year is only 4 quarters long. But certainly since about the second quarter or so, we talked about that the performance this year is not in tech stocks, although it's the best performing sector based on a few stocks. Of course, that's the risk, but it's actually in pretty much anything else, right? And so if we look at the market through the lens of a more broad lens, which is, I think, the fair thing to do and the sensible thing to do, you will notice that, once again, if you haven't heard this before, look at the performance. Gold miners up almost 60%. Silver, don't look now, but it's up again this morning. Gold, platinum, palladium, copper, you see a theme, right? And we actually think that 2026, and this is our theme for the year, thanks to Christian who coined it, He's in the chat room here as well, by the way. We'll get to his thing in a second. We think 2026 is the great rotation trade. Well, 2025 for us was the year of the trader. It sure was, right? We coined that about 13 months ago, said 2025 would be the year of the trader. Ended up being so. Big sell-off, that started off in February when we got our signals. Then we received the buy signals coming out on April 30th specifically. Momentum that lasted all the way until basically about a month ago. And since then, we've been a bit choppy. So that's kind of where we're at right now in terms of performance. So, when people talk about tech being the best sector, it completely misses the point that there's other parts of the market that have done way better, and we think this was the beginning of what we call the great rotation that we're going to see starting in 2026, which is probably where a lot more money is going to, at the margin, come out of tech, not cash out of tech, but that sector is so big, right, that even just a little bit of money out of tech is going to basically able to levitate many other parts of the market that people have left for dead for years now. And that's going to probably hurt most people's portfolios. Most people that have an S&P 500-centric portfolio are probably going to have a really poor performance, relatively speaking, and quite frankly, probably absolutely speaking, we suspect for 5 to maybe 10 years. So it's a great time right now to kind of get ready for what we think is coming next. Of course, I don't have a crystal ball either. Unlike most YouTubers, I don't pretend to have a crystal ball. We can do research. We have to be flexible. And that's about all we can do having a process. Thank you, Joel, for the reminder. Yes, please give us a thumbs up, like that would be helpful. So that's what's going on in terms of performance. So the question, of course, is where does that leave us with some of the stocks that everyone talks about all day, every day, like NVIDIA? I want to bring up 2 charts here. We're going to look at NVIDIA, and then we are going to look at 2-year yields. Quickly, though, just as an FYI, particularly if you are a PPIS member, we really like the idea of Schwab here right now. This stock, as you can see, is acting very well. This is purely technically. There's a lot of reasons why structurally it's acting well. For purposes of our morning call here, we're going to keep it technical for right now. But essentially, you can see this stock has been consolidating here for the better part of the past second half of the year, consolidating above what used to be resistance. Now looks like it's becoming support. So we think something like Schwab could do quite well here going forward. This is a multi-week, multi-month lens at this point, and we'll determine after that. So this is a quick FYI. Let's look at NVIDIA, and then I want to look at the most important chart, which is 2-year yields. 2-year yields. So let's get to it. So here's NVIDIA, and I want to give you a little bit of an update. This morning, the stock is up about 1.6% pre-market, so bouncing a little bit. But I did want to bring it up again, and this is just to stay open-minded, right? So this is the daily chart of NVIDIA. We don't think it's necessarily a short. It has to break support for that, but it's a stock that I probably would have a very difficult time buying right now. Just because it's kind of been a chop zone and it's been consolidating. So I wanted to point this out again because there's a lot of narratives out there and storytelling, and you can see how wrong many of those people were, the talking heads, as we came into the fourth quarter of this year. You probably noticed that most of them were totally wrong in terms of their fantastically beautiful, amazing, high-flying kite calls about Bitcoin or something else. For the most part, they're dead wrong. NVIDIA has, in fact, done absolutely nothing since about late July of this year. That does not mean the stock can't bounce here. It absolutely can. The reality is it hasn't done so far, right? I would watch very closely what NVIDIA does around the 170 level or so. If and when the stock were to break below there, I think it could get quite dicey. So that's something I would watch here very closely. Last but not least, unless there's questions, and maybe actually last but most importantly, I do want to remind everybody of yields. In fact, the chart that I showed you on Schwab before is actually, I think, a pretty direct result. The bullish chart is a pretty direct result of what's going on here in 2-year yields. You know what they say, when in doubt, zoom out. You may have heard that before. It's a kind of an old technical saying in the markets. Here is 2-year yields, and what I'd like to focus on. I've shown this to you, to many of you before. This is what you call the hedge fund trend following trade, and let me explain to you what it is. So you can look at some of the greats. I don't want to generalize too much, but some of the great hedge fund managers over the years, and you may know some of their names as well. They have often admitted or just said that a good chunk of their money over the years came from basically trend following yields up or down through the lens of futures on the short end of the yield curve. If you only trade stocks, whatever I just said is probably a foreign language that you don't really care to learn. I'm going to tell you right now that if you want to make money in markets, more than just a few trades, but wealth, you have to find an asset that is trending with as little volatility as possible, right? And so the rates market, so particularly the short end of the yield curve, the treasury curve, here you're looking at 2-year yields, has the habit of when it begins to trend, and it's not trending right now, by the way, but when it begins to trend, it tends to do so in a very steady and relatively low volatility manner. So the reward to risk from a trend following perspective, particularly it's done in a levered way with futures or options or some levered ETF nowadays, I guess is part of it as well. It lends itself very nicely for that kind of a trade. So it's more difficult to get chopped out of the trade. So just to give you a little bit of an idea on this, and we're going to do our next state of the market update in January, and we'll go through this a bit more so everyone understands this a bit more. But let's just go back to, let's say, 20 years, okay? So if we're 20 years ago, or back in, actually almost 20 years ago, you saw that the 2-year yields started topping out and then began breaking down hard in August 2007. And then you can see that yields, so one could have here basically, it's the inverse here is price, right? So if yields go down, price goes up. So one could have bought futures here, one could have bought on 2-year futures, one could have bought an inverse ETF, options, whatever. The point is it's trending, right? You can see ultimately it trended in a pretty orderly fashion without too much volatility. There's certainly volatility, but nothing like the equity market. Then we started the trend reverse, and you can see after basically basing and consolidating, the trend started reversing to the upside, right? And you don't have this as much in equities with this low volatility. Then, of course, we had a rates come down hard, starting in really it started coming down in the second half of 2019, but certainly heading into 2020, right? And we actually called it the trade of the decade, but it started a bit earlier. I should show it to you like this, right? So rates started then breaking down again. That's this. And then again, rates basically fell off a cliff with COVID, but they started moving way beforehand, right? This is the thing. A lot of people thought that COVID was the trigger. It wasn't the trigger. The economy was already slowing, and then of course the opposite. When we had the temporary what do they call it? Temporary inflation or whatever the word was they used. And then, of course, rates started basing and then blasting higher, which would have been this would have been the sign to basically short futures or buy calls, whatever the instrument is using. And now, and this is why this is so important, I'm getting to it right now. Here is where we're at right now. I am of the belief that the next move in yields on the short end is probably lower. I don't know how much lower, right? I kind of doubt that we go, much below, even 2%, maybe 1.5% at the most. I don't believe we're going to go back into the zero rate environment. I don't think we're going to probably make a higher low, so maybe 2% or so. But the point is that we're basing here, and if we have a dovish Fed head coming in the spring, then I really believe that the next move is lower. So that would mean yields go down. So this would basically mean buying 2-year Treasury futures or buying calls or doing something bullish on rates as in price, right? Bearish yield, bullish price. So I think the ETF is TBT or let me just, I typically don't do the ETFs too much because they don't really move a whole lot. Let me just see here. Yeah, exactly. So it would be, I think TBT would be price, right? Or TLT. I don't know. I can't remember anymore. Which one is which? I'm guessing it's probably TBT. Yeah. TBT would be an ETF for that. 2-year price treasury bond. Yeah, exactly. So anyway, I'm hoping this is helpful. I know I'm babbling a bit here, but this is the kind of stuff that if you're looking for real wealth generating kind of things, this is not a promise or a guarantee or certainly not advice. I'm just telling you the kind of stuff that you want to look for as a trader. And then I'm hoping, I know this is going to be a topic for us certainly in 2026. Wealth is typically generated by staying trends, and the lower volatility they are, within reason, the better and easier, quote unquote, it becomes for us to stay with that trend, right? So I'm watching this one like a hawk, and I'm looking forward to this one triggering. I think the time to position for it is now, not when it's too late, because once these things start moving, they can move pretty quickly, and then again then you have sort of buyer's remorse, right? You don't do it and you wait and then it's too late. So anyway, I hope this has been helpful, folks. I'm going to close it down here. We went a little bit too far today, a little bit too long, but I hope it's been helpful for you guys to be able to kind of, follow this sort of trend following stuff. This week, actually, we're talking about sector and group rotation. And as Christian just put in before, so we're doing one educational session this week. I think it's tomorrow on the 23rd of December. If you would like to learn more about how to rotate through sectors and groups of the market as they become, or even like this, right? Like we're looking at here, if you want to learn how do we find these kind of trades and how you can rotate and allocate capital to new things that are either trending. In this case, this actually is a trend. Remember, if yields go down, price goes up of bonds. And again, this can be done with ETFs. Make sure you sign up for that. This will be a great session this week. Again, Tuesday, December 23rd. That's tomorrow at 11 Eastern, 8 a.m. Pacific. And we'll teach you how that works. If you sign up, you're going to get access to an ebook that we released about 2 weeks ago on some pretty bold predictions we have for 2026 and beyond for the S&P 500. I think that should be helpful for you guys as well. So obviously, as you know, it's a free educational session. We call it strategy session. We do it once a week. This week's topic is sector and group rotation. And if you enjoy this idea of what I just talked about here in terms of how we might be able to find the next move in bonds in this case, which can be done with ETFs or obviously futures and options, that's the kind of thing that we call sector and group rotation, rotating through the market, which is something that certainly has proven to be a great strategy over many years. So hopefully this is helpful, folks. Thanks so much for being here. We'll see you guys tomorrow morning one last time for this year as in Set the Market before we pick it up again in the first week of January, the first full week of January. Yeah, that's it for right now. See you guys back here tomorrow, and be